Hello, and welcome to another episode of BitThink with me, Christina. I haven't made any videos for a while just on my own. I've been really enjoying the work I've been doing with Mr. Daniel Krawitz. And I am working on a couple of longer, more thought out videos with regards to investors, traders, the prediction markets, and how we can best read them for a new brand of crypto entities as well as investors and traders, along with some other thoughts about the nature of what we actually mean when we use the word money in the context of money standing for a whole range of functions. But today I wanted to just upload a real quick video where I share some of my reflections on what has been happening to the market overall in terms of its great signs of life, meaning enormous volatility and massive price movements. So this is CoinMarketCap as I record this, and we are beginning to see some of the green and these little upticks here. But I think it's fair to say that in the last 48 hours, 72 hours, however long it's been, the market has definitely given people, whether they're old investors, new investors, or really super new investors, a baptism in crypto fire for sure. And for even the most veteran of Bitcoin investors, Bitcoin users, and cryptosphere veterans, it is fair to say that retracements in the order of 50% are pretty spectacular events to live through. Now, it is for sure true that the more often you have ridden the roller coaster, the more certain you are that you are not in fact going to die and that you will live to ride the ride again, the more you can take in the view, a la Mr. Bean. So over the last couple of days, there are a number of commentators in the space who I respect and who I think have good things to say, who have pointed out that asking the question, why is there a sudden and profound sell-off in the market in a particular coin in general, why is it happening, is not a very useful question to ask. And Chris over at Cryptoverse definitely makes it clear, which I think is a valid point, that to a certain extent, why it's happening should not matter in the first instance if you have faith in your underlying investment thesis, that there's no circumstance that is going to cause the thing you're invested in to simply stop to existing, and that you should have essentially a plan in place so that the thinking about the why is not particularly relevant. And as I say, I think there is something to be said about this from the point of view of what kind of decisions one is making as an investor, as a trader, as both, or even as a gambler at the outset of putting your money or your liquidity into anything. So the ability to follow your own premises or theses through to their logical conclusions, to act accordingly, and to have faith in your own set of risk assessment decisions is one approach. However, I do think that it is worthwhile trying to pay attention to what is happening in as many different places as possible so as to try and understand the markets as they continue to both grow, unfold, and manifest themselves right before our eyes. So a term that I've come across recently, which I think is really excellent, is skeuomorphic. And that means that an old part of an old system works its way into a new system. And I'm going to speak more about this with regards to how difficult it is to be in a transition phase and not suffer from some of that. So one of the things that's true about the market that exists now globally in a way that has not existed before for Bitcoin and cryptos is that we are having to teach ourselves how to even recognize what it is that we're looking at in the first place. And so taking a kind of Aristotelian approach towards figuring out why, which means entertaining any and all possibilities without having to commit to believing absolutely or even partially in any or all of them, is a good exercise for the mind. And the first thing that it reminds us of is how this is a global phenomenon, and we who are in the English-speaking world and then in the kind of Western world are very much restricted in our access to the motivations and conversations um, that are going on in places that have a language barrier to us. And then furthermore, large parts of the world where, for example, the major exchanges are not located. So while we in the English-speaking Western world may have obvious language barriers with Asia, we are much more able to watch prices coming out of those regions. We're not yet in a position where we have as much information about what players in South America or South Africa or the rest of Africa or India are doing by way of response to or participating in any of the reasons why the price is moving as a large as sort of a large fashion as it is. And I think what's interesting to also think about is not even so much only about why are the movements so large, but what also might be affecting the rate at which the desires or decisions of other players in the market, the delay in their capacity to express those emotions. So there are two theories that I like that are currently circulating with regards to the timing of the sell-off or the profit taking, whichever way one is inclined to look at it. And the first thing that seems to have a reasonably good case behind it is the observation of a pattern around Chinese Lunar New Year. This is a pattern that seems to be legitimate by way of presentation, and I think that anybody in the English-speaking Western world who has recently been through Christmas is entirely familiar with the fact that shopping for Christmas generally starts around Thanksgiving or about a month before the climax of the events, and that that's not an unreasonable perspective to take on the Eastern world either. I think likewise in the context of the West, regardless of the specifics of your particular jurisdiction's tax timetable or rules and so on, we are into that part of January where, crypto or not, many people are coming to terms with perhaps what the overhang of cost of Christmas may have been, and or looking towards the upcoming year in terms of immediate incoming fiat needs. So I think that some awareness around seasonal needs and the kind of rhythms of human culture, spending, and even some of the natural rhythms around winter, spring, summer, and so on are worth overlaying the current market moves. I also think that this gentleman here at Crypto R Us, who has a fairly daily posting on the market, made some strong points with regards to what may be happening to the market with the BitConnect sell-off. I think it is probably fair to speculate that there are a significant number of Bitcoin suddenly coming onto the market, and it is worth thinking about what the impact on price may be if there is effectively a player in the market that dwarfs all the whales put together. I do think it's fair to say that there has been the coincidence of a couple of forces, one which may be sort of deeply embedded in all markets, and not surprisingly still embedded within the new crypto market, that of seasonality, rhythm, flow, phenomenon that a new friend of mine, Mr. Cruz, pointed out. The markets can be seen to follow very natural rhythms, and one can see massive runoffs and then sell-offs as a market's way of having an orgasm. And one of the things that I may find myself talking more about is how that's more like a female orgasm, where you reach a plateau and then you have a series of further peaks before descending back to a latency form. I'm not 100% sure. Maybe we can come up with some interesting charts. But I do think that there are rhythms and contexts that are deeply embedded and that require even the most sophisticated observer and analyst of this new market to kind of really expand their knowledge base and to start thinking about what those might be in parts of the hemisphere and in language and culture forms that are, unknown, let's say, still at this point to even your highly educated investor or market participant. But I also think that there are obviously exogenous shocks to the system, and the collapse of really the most spectacular Ponzi system in the Bitcoin space, Bitcoin Connect, is for sure yet another example of how Bitcoin and crypto by extension has in it degrees of anti-fragility that only manifest in the process of being attacked. And to watch the price of the underlying value metric, Bitcoin, absorb both the psychological impact and potentially the actual selling impact of both the ripping away of the emperor's non-existent clothes. Yes, there really are Ponzi schemes, and in my longer video on what it's like and what we can learn from a free, deregulated, and therefore transparently manipulated market, the psychological impact of that is nevertheless like quite traumatic. And then simply any large amount of supply coming onto a market is going to shift its price. So these have been interesting times for anybody who is emotionally able to, and I guess cognitively open enough to really look beyond what seems to be either an obvious emotional reaction or an obvious intellectual reaction. And so a quick last point about two other features that I've been thinking about over the last couple of days as I've watched the markets in as many different ways as I can, both through the actual exchanges, as many as I'm able to watch on through to the kinds of conversations that are existing in as many media as I can follow the language of. Two features, structural features, have been on my mind. One is what happens when the asset that you're most likely to panic sell is locked away in a vault, in a hard wallet, or in some other form that it really requires both effort and time to get to. This is a very useful form of helping oneself if one has decided in the course of an investment at the outset that it's a long-term holding. And the other is the flip side of that, which is that the impetus to buy a dip or the impetus to respond to what one knows or one feels is a really great price is hindered when the mechanism for getting the fiat to the place where you can buy it is not instantaneous. So you can't do it quickly or easily unless you are using a credit card, and still in that context you're facing some barrier of penalty of higher price. But certainly I've been aware of the fact that the structure of the market means that there's a disincentive to keep a great deal of ready cash on the exchanges. And at the same time, it is difficult and lengthy to get the cash to the exchanges in the event that you want to get it in and up and operating. So I think that when we look at a market that is both moving so fast and also moving so slow, it's worth thinking about the fact that we are going to have to develop more sophisticated ways of both measuring and then interpreting what we see this fantastic prediction market telling us. And as Mr. Daniel will tell you, strong investors and strong developers both need to start paying attention to what this new prediction market is trying to tell us.